Good morning, my fellow Americans, and good afternoon to everybody else joining us today. Thank you so much for joining us once again for a new edition of the Dairy Café, Vesper's bi-weekly effort to keep you updated on everything and anything that's happening within dairy. You're joining me and Seb, the trusty sidekicks of our analyst Jasper, who once again today will talk you through what's happening in markets, answer any questions that you have in the chat. But for today, we have scheduled for you, I think, a little bit of a fundamental episode. We'll travel across the globe, looking at the different dairy hotspots, see what's happening, see how much milk is there, and spoiler alert, it's quite a bit. But also see, why does the market feel like it's feeding at the moment, while fundamentally it is where it is at the moment. Sounds very cryptic, but we're going to dive into that in the coming 30 minutes, and Jasper's going to take all of the cryptic out of that sentence and explain exactly what we mean. Jasper, are you ready for today?
Yeah, I'll replace the cryptic questions by political answers. Let's see if it's still cryptic.
Yeah, exactly.
That sounds boring. And first, we'll go to Seb for a little bit. Sebi, how's the marketplace doing?
Yeah, good. Now, as you said, it's a bit of a weird one. We have fundamentals going one way, but then we have the market not per se moving another way, but just not moving in certain directions. I think we're going to talk about, proteins feels very volatile, while we actually have the rest of the market that hasn't moved too much. Skim a little bit down. It seemed like it's finally, kind of easing off a bit. Does that mean that fundamentally it's changing? I don't think so. I think that there is quite a bit of demand. Export is doing well, so I think we can sustain those high level prices, or higher level price that we've seen compared to the last year. And butter is extremely strange. As we hear, there is milk, cream is feeling very heavy, but in the same time there is no demand. Q1 for sure not, but Q2 on spot not at all. Q3 neither. So people are mostly looking at Q4 2027. We've done a lot of deals, but mostly for 27. I think we've had the most volume trade on the marketplace this week. But everything is looking Q4 or further out. One just got done today on the 4,000 for July, so that is interesting as well. So it is feeling, as soon as there is a buyer, it seems like it can find product, because I think that there's just a lot of product available. But the question remains, but producers are not putting too much on the market. So what I'm wondering is, where is that product? Where is it going? And maybe they think, listen, we're going to store it and see further out to see maybe we can see some firmness. I do believe that if everybody does that, it's just going to keep a bearish sentiment for even longer. And that's why I think we're seeing quite comfortably a lot of deals being done in 2027, because people, and especially traders that can offer that far away, feels that it's safe to do so. Feel that they can have the product by then. So that's what we've seen in the marketplace this week.
Great. Well, I've shared a little bit of an interaction on the screen. If you want to learn more about the marketplace, please click the button and Seb will be in contact. But Jasper, going over to you. What's happening? Where do we start?
I think I have a great image from our screen share that we can use to start, which is the global milk supply. We accumulate the numbers from Australia, New Zealand, Europe, US, and also Argentina, Uruguay, to have a bit of a feeling on, okay, who are the biggest exporters and what are they doing in milk production. We have been talking about an increased milk supply for a while now, and also January is no exception. So if we take the global milk surplus in January 2026 compared to the year before, it's plus 4.29%. It's massive. It's just shy of the numbers that we saw at the end of the year, but they're extremely high. And I think this is kind of the thing that surrounds all dairy markets at the moment. Even though we do see some opposite price movements when it comes to proteins, it's not the availability of milk that's really the kind of a problem right now. We have enough. It should lead to plenty of products being produced, and that's generally why markets fundamentally are weak, stay weak, and also a +4 milk intake doesn't disappear overnight. So this is going to stay for a little while.
Yeah. Well, we have seen maybe as we're talking about milk production, we saw that France was starting to lag a bit, or at least behind numbers.
Yep.
Any explanation there? Is it a reverse of the trend, or is it just a couple weeks that cows are inside or in between periods? I've heard some stuff.
Yeah, I think it's good to zoom in on all individual regions. I think Europe, US, and New Zealand were on the agenda, but I think starting with your question, let's zoom into Europe. For France, of course, in France. So there we go. French milk intake, we have weekly numbers, which is different or more granular than we have for others. If you look at these numbers, and I've only included 2024, 25, 26, we do see indeed that the milk output is slowing down. What is good to mention is that the numbers before at 509 compared to 480, it's a massive surplus, and that surplus is now shrinking. It's still a surplus, but it's shrinking. But I think it's very fair to mention that the 2024 baseline is a good one to compare with. But compared to 2025, we've always been saying we will have a great milk intake compared to 2025 in Q1 because it was horrible. But now we're into Q2. Q2 is the moment where, okay, we're going to start balancing out compared to the years before. Last year in 2025, that's when the milk output started rising. So this is really the moment where we're going to start seeing, okay, how is the output going to change throughout the rest of the year? There's a couple of important points that we highlighted earlier already, which is the milk price. The milk price is still seen as generally high. I wouldn't say it's nowhere near as high as we had in previous years, but around 40 cents, slightly lower in some countries, slightly higher in the case of the Netherlands, for example. We still have a milk price that should support plenty of milk being produced. So yes, we see a slight decrease in milk output. We do still predict that the milk output is going to stay good. So even in Q2, we will see a more balanced market compared to previous years. We don't expect this to continue and fall through 2025 and even fall through 2024 numbers. I really think it's rather a bit of a peak that's come a few weeks early. But in overall, we don't really see this as, okay, we've now turned into a tight milk supply. We really don't think that at all. And even if we stay close to the 2025 numbers, it's never going to be tight. It's still going to beat last year's numbers by far. So we're seeing a decrease now, but milk price is good enough. The number of cows is still strong enough. Feed prices have been higher, but still okay. So I really feel like it's rather a kind of a start of an adjustment to, we're comparing against a good year now, rather than a real deficit in milk. I think that's also what we see, for example, if we look at Germany. Germany also has a great weekly milk output number. The surplus is still 6.5%. So yes, it's slightly lower than previous years, and we might be reaching the peak a few weeks earlier, but there's no reason to believe why we should really go to a deficit right now.
And how do we explain German, for example, the German quotation staying, I mean, we're seeing here so much milk, and the German quotation for butter staying so high?
I think there's multiple things at play here. I think the Dutch market at the moment is actually one of the weakest. Why? Because we see that plenty of traders and also some producers actually have fresh spot product to sell, or not fresh, that they have product to sell on spot markets. And in Germany and France, they're able to store it slightly better. They have a bit more storage capacity, and they're really trying to wait out as long as possible by storing volumes for later in the year. In Europe, so in the Netherlands, they're doing the same thing, but storage is full. So that's really creating a difficult market where in the Netherlands, we have more volumes to sell, and therefore butter the price is slightly lower. In Germany and also in France, those prices are still slightly more elevated because we don't see the same pressure to sell on spot markets.
No.
If you look at forward markets, for example, the price difference is much narrower. So it's really about how much needs to be sold today rather than the availability in the future.
Okay.
I was preparing for this episode and looking at Dutch milk as well, and looking at Dutch milk prices, because even though we might not have a weekly price source for the Dutch one, so you need to wait for official reporting, I did see a quite interesting pattern in pricing, and that is pricing between guaranteed payout price and between the traded milk price on a weekly basis that we have in the VPI. Can you show us what's happening there as well?
Yeah, I can. I think this is great to just look at the milk price of Germany and the Netherlands in this case, and then compare it to the Friesland-Campina guaranteed milk price. I'm pretty sure you're interested in the difference between these two, right?
Yeah.
Essentially what we see is that because of this milk surplus, which is taking place in Germany, it's taking place in France, it's taking place in the UK, Ireland, the Netherlands as well. We have a large availability of spot milk. And that spot milk is trying to find a home. And in most cases, all co-ops, because commodity prices are actually doing well, and farm gate milk prices, as mentioned, are not as high as they were in previous years. I think if we look at 5 years ago, they're not at 60 cents, they're at just above 40. So with low milk prices, these co-ops are gathering everything, all the milk that they can get, and producing a lot of commodities. It's really favorable at the moment. But the milk pool is slightly too large for some of these co-ops to process all themselves. So next to everything that they use themselves and produce commodities with, they also have to sell stuff on spot markets. But all the co-ops are running into the same issue. If they've already filled up all their production capacity with the farm gate milk, it's hard to really just start picking up spot milk as well. And basically transfer some old facilities into operating facilities. We have seen some of that take place. So in Germany, for example, we have some skim milk powder drying towers being turned on. SMC is going there. Skim milk powder is being produced because there's a profit margin. But generally, we see this this difference between these two prices because there's a lot of milk. All the co-ops are already full. At least their facilities are already full, and there's still more milk than coming in than they can produce.
And this is a pattern we see, of course, every spring flush. More or less, you'll see a widening gap between these two prices, as you just explained. But with how large this gap is now, so how large the spread has become, how sustainable is this, and how hurtful is it also for your co-ops who are buying that milk for the high price and, well, the surplus they sell for the low?
Yeah, I think if you zoom in on the difference between the spot price and the farm gate price, it sounds like it's incredibly painful. And don't get me wrong, it is. It's not nice to buy something at 40 cents and sell it at 15 or even lower. But this only happens with the milk that they cannot process into commodities or retail products or whey proteins themselves. So this is really only applicable to a small surplus of milk that generally these co-ops have. So what I'm trying to say is that these guys have plenty of processing capacity for a lot of commodities on which they're making profit with farm gate milk. That this bit of spot milk, it's not great, but it doesn't hurt the overall picture. And it's really still pushing for kind of a happy co-ops at the moment. Yep. If we're talking about happy co-ops and also happy farmers, I think it's time to go to the United States.
Happy co-ops there?
I think we generally have happy co-ops because of the amount of milk available.
Yep.
And I'll show you the standardized numbers again. US has never seen this much milk before. There's so much being produced. Certain states, especially in the South, are growing a lot. Midwest is still growing. Even the West is recovering a little bit. So countrywide, we still have a lot of milk available, especially regarding milk fat. A lot is being pushed there. But there's one product category that's not necessarily seeing as much milk as you would have guessed. And I'm actually switching to the 𝗕𝗵𝗲𝗲𝗀 prices for this. Which is the non-fat dry milk price on the 𝗕𝗵𝗲𝗲𝗀. I'm zooming out 5 years for a particular reason. I can even zoom out longer if we're interested. We have reached the highest non-fat dry milk, which is the equivalent of skim milk powder in the US, not exactly, but it comes down to the same product, milk powder. The highest price on record on the 𝗕𝗵𝗲𝗀𝗀. And for the ones that don't really recognize the $2.16 a pound price, I'll transform it into US dollar per ton. This is almost $5,000 a ton, $4,750 a ton for a milk price. For a milk powder price. Yeah. It's massive. So that surplus of milk, that fundamental surplus that we see in the US, is finding its way into butter. If we look at the overall price level for butter compared to the last 10 years, it's low. If you look at cheese, I think blocks are always a great thing to look at. average, if not slightly lower than the last 5 years, or sorry, 10 years. And then there's non-fat dry milk. It's really interesting to follow and see that a market can change this much. And of course, we haven't seen a lot of production of non-fat dry milk in Q1, in Q4 last year. Now, anyone who has, of course, anyone who can is going to start producing this together with butter. It's a great return on your milk, and it definitely helps.
And do you expect that with those S&P price that we have right now, do you expect the farm gate milk price paid to farmers to stay high, thus then continue to produce in such high numbers as we just talked about before?
In the US, yes. But of course, if non-fat is the only product that's really moving up, while butter, and also I think I will zoom in a little bit for this, while butter and cheese are not really doing that well, we are not expecting a huge pay rise or a great paycheck for farmers. But this definitely helps. It's going to improve at least the milk protein factor, and it's going to push them to keep producing as much milk as possible. But they've already been doing that for, let's say, 3 years.
Okay.
As you said, non-fat, we would usually compare to global S&P prices. Yeah. We always say this is a large export product. Does that mean that with the US rising 85% year over year, that European and New Zealand prices are also inflated?
Absolutely, but the difference is huge. I think here it's always great to put them up on the same graph. So I'll put in the EU and Oceanian VPI, and for the sake of it, I'll look up the non-fat dry milk on the 𝗕𝗵𝗲𝗁 that we just looked up. And then in dollars, of course, because this is rather a global market. Zooming in a little bit, we have seen a massive, even more, so it's clear, we have seen a massive rise in these prices. So they started at 2,500 in Q4 last year, and now we're just shy of 4.8. The difference between these and the other commodities has grown in the last couple of weeks, but I think, Feiko, indeed, what you're mentioning, at the start of the year, they all started increasing at the same time. US started pushing up. It's a really an export-dependent market. Big countries or regions such as Middle America, Mexico, or North Africa, Middle East, Southeast Asia, China, they're really dependent on exports from these 3 regions. So if one of them moves, generally they all move, but it seemed like that kind of situation has disconnected a little bit. All the way from, well, let's say the end of Q1, we really see a disconnect. And if you want to make use of some arbitrage between the US and the EU, for example, on S&P, I think now's the time. So we have 3,000.
Do you think that that's going to happen as well?
For people who have the chance, yes. It's more difficult, and it's not easy to, if you're used to non-fat dry milk, slightly higher protein percentage, and suddenly you start importing S&P, it might cause some difficulties. But we can actually look at the spread between non-fat dry milk and S&P Europe. With a spread currently at $1,639 a ton. Shipment was roughly $250 a ton, and there's an import tariff, but there's still a $1,000 plus spread between these 2 prices, even after shipping and tariff.
Yeah. Okay. So we might see some European products coming to the US.
If there ever is a moment to do it, I think this would be it. The spread is large enough. The need for spot product, like we see being confirmed by the 𝗕𝗵𝗲𝗁, which is the price for really spot delivered S&P or non-fat dry milk. The need is there. The volume is on our end. We can produce a lot. Why not?
We got a good question, or at least it's one of my favorite questions already. And that is the question, how is the combination of butter and non-fat doing compared to cheese and whey?
Yeah.
That's which is a valorization question. We always get excited by those.
We love a valorization. Underused. It's a sleeper, a great one.
That's a Dairy Café. Are we talking about US or Europe?
US, I assume, as I see a non-fat in the question.
Yeah, in that case, we'll look at US dollar and US. So I think as we predicted, compared to January, when everything was actually up to the same level. So our milk valorization shows you the output, or basically the amount of volume that you can make multiplied by the price of these product combinations with 10,000 liters of milk. In this case, we see that non-fat and butter has exceeded the other two markets by a long shot in this. And I think what's something that I learned over the past months is that the impact of milk powder on valorization is actually quite larger than I imagined. Also, for example, whole milk powder, the price is based on butter and skim milk powder in Europe, and the same here. And we really have a big percentage of the price being determined by skim milk powder or non-fat dry milk because the volume's that large. And if you really see, okay, for every kilogram of butter you can make 2 kilograms of non-fat dry milk. If the price goes up by 80% in such a short time, we really see a big change in valorization, and it's exactly what we see here.
Yeah, but so there's a follow-up question, which I think is good. If you can produce with that cheese and the way that you get out of it, if you can produce WPC80 or WPI's high proteins, how does that change?
It definitely changes a bit.
Only a bit?
It changes more than a bit. So the image is much more similar to this. But I think what's good to note is that the total amount of whey solids that go into the WPC80 stream is still relatively limited.
Yeah,
especially in Europe. In the US, it's much bigger. We also have a large production volume of WPI. But of course, if you can make cheese and dry whey or cheese in WPC80, WPC80 is doing much better. But also dry whey is not that low. So I think it's not as good as non-fat and butter, but much better than cheese and dry whey.
Clear.
I think this is the time to look into the final region of the three. For New Zealand, we always tend to look at milk solids when we're talking about New Zealand. They're dealing with a lot of exports, of course, and they need to transfer these commodities, this milk into commodities first. Also there, the surplus is still there. We actually see a surplus all the way from 2025 heading on to this year. We're going to end the season with that surplus as well. The next year, the March volumes will be published on Monday, but we also predict these to be up. So the 2025-2026 season is definitely expected to be great and stay great. And still, I think the interesting part is that, of course, for next year's milk season, we have to look at the milk price. We have to look at the weather, how that will play out. Well, the weather with El Nino, I'm not sure if Super El Nino is still on the roadmap, but it's there might be some slightly less positive signs, but we're looking at the milk price. We're still good. So we know that New Zealand, and that's what we've been talking about with guests as well in our previous dairy cafes. If the milk price is there, Kiwi farmers, New Zealand farmers, will deliver. And at the moment, we see that milk price is still roughly $1 below the break-even level. So the break-even level is around $8.50 per kilogram of milk solid. It's still above $9. So we definitely don't see any reason to believe that it's going to be a lot lower. But as I mentioned, the weather could definitely play a role.
Yeah, it goes very quickly there, right? With guys being outside.
Yeah.
So it's definitely something to watch, especially. I mean, for the moment, it doesn't have a big impact. We're going into the ones that we have less and less milk arriving, but especially going into the August to September time, that is a big one to watch.
This is also a great and underused widget we have.
100%.
The pasture growth index. This is your earliest indicator you can get on milk production in New Zealand, and also how the weather is impacting the pasture. We know, of course, both New Zealand and also Ireland, big pasture-based systems. So the pasture growth is an incredibly important thing to look at. If we look at how this has been developing over the past months, in blue, we see how the current state of the pasture is doing. In yellow, we see what the 5-year average is of that pasture growth. So we see that this has actually been a lot better all the way until the end of Q1. At the start of Q2, however, we are starting to see a switch. So the weather is starting to play a bit of a role here. Of course, we're at the lowest and in the winter, or at least the late autumn season. But we do predict that if this starts going up towards the start of next milk season, together with the milk price, which is also up by then, we're going to have good milk availability coming from New Zealand again.
Clear.
if we look at all these regions together, Jaspers, we see there's more than enough milk to go around. There is some supply constraint, I think, on the more on the higher proteins, so not so making that can keep growing while fundamentally so strong.
Yep.
For me, there's a trick situation there, is that it doesn't feel at all times like it is fundamentally as strong as it is. There's products, we'll look at non-fat, that can happen. But I think also just the sentiment is still that it's quite on edge. Can you explain that combination?
Yeah, I think we've been talking briefly about this before, and I think it's there's a couple of crucial things that are that we should highlight. Because yes, indeed, if you purely steer on fundamentals, you wouldn't say that there's currently a need for a lot higher prices. So there's no need to be afraid. Relax, let the market do its thing at the moment, and let the supply side push prices down, and then come back in a few weeks, few months when prices are lower and lock in some volumes. But even though that might be the case, we still see that people are on edge. Well, why? Because in this market, and I think I can include year-on-year change in this, looking at dairy as a whole, there's always one side of the market that's booming. In this case, milk powder has suddenly short squeezed, and the price increase of 80% in a few months' time. WPC 80 reaching the highest levels on record. But I think butter also being a great example. We've gone from prices of, well, in this case in US dollar, from 9,000 to 4,500. So we were cut in half by butter prices
in the year, yeah.
Which only tells me there's a lot going on in this market still, and that's kind of still keeps people on edge. They know how quickly it can turn, and it keeps people afraid that, okay, prices might go up. So whenever I see a slight adjustment upward, we see so many buyers locking in a lot of volumes just to make sure that there's no risk. They hate the risk.
Yeah. No, and probably due to that volatility as well, people are, as you said, are on edge. And so when something happens, everybody jumps in at the same time, does the same thing, and that kind of accentuates all those peaks and those fluctuations, which we've basically seen, right? Just a massive drop down in a few months, prices either doubling or halving within a couple of months. Those are things that we haven't been used to, actually.
Yep.
And as you said, I think you said it rightly. It's people are on edge, and people are afraid of those high prices, and that has a massive impact on their costs and on their margins. So
and I think from to add to that, I think on a more theoretical level, having a background in logistics, we as a commodity market, we're going for the optimal balance between supply and demand. And it looks like, at least at the moment, that balance is quite thin. So yes, in today's market, we have a large surplus of liquids, but large used to mean a lot more and a lot more significant, a lot more absolute volumes than it does mean right now. Yes, we have too much milk, but it doesn't mean that we have twice as much milk as we need. It's like a small surplus of a few percent. Yes, indeed, it is too much, but we also know that can turn quite quickly. And in the long run, we know that we're in a slight deficit of milk. We all kind of are not anticipating it, but we're slightly earlier on the buying side and then be a bit later. So yeah, that balance, because it's much thinner, will automatically create more volatility. If we have an oversupply, prices will react quickly because they've already been reacting quickly when there's an undersupply. So really, we keep overshooting a balance rather than staying at that balance, and it's really difficult.
So it sounds like being on edge is also, it's not something that people are doing wrong. It's just it's totally fair, especially if you look at how prices can change over a year.
Yep.
That fundamentals, don't tell. It's not just it's fundamentally strong. I can sit back and relax. It's probably not the way to go. It's the moment to make strategic plans. We have two more questions, where I think the first one is a follow-up on the earlier one, which can probably, the best place to look for it is look at production widget that we have, see where non-fat levels have been in the past. But I think the other one is where you'll probably need more than a minute, is the forward price and availability view on WPC 80 in Europe. If there's any comments you have there.
Yeah, so the interesting part is for WPC18 in Europe, generally we've only seen quarterly contracting take place. So in 6 weeks before the next quarter starts, we see that people start to trade the next quarter. So that means in a month's time, slightly less, slightly earlier probably, we will see Q3 trades take place. But because the market has been this tight, we see that period has been extended. It's an incredibly costly exercise to lock in all your volumes for 2 quarters in a row, because every truckload is, well, if you multiply this by 24 metric ton, you end up with roughly $500,000 for every truckload. But we are starting to see that producers are also offering Q3, and in some cases even Q4 at relatively similar levels. Not that much of a premium. There is a small premium, but slightly higher levels than we see today. So we had some Q3 being traded at 21.5, and in some cases somebody wanted to buy Q4 at 22, but didn't take place, of course, as you can imagine. So forward prices are starting to become a bit more of a thing in 80, but only for the ones who are willing to. And I don't really feel like that's
a lot of people. Yeah,
buyers might want it, but as a seller, sellers might wait a little bit more, see the price move up before really locking in longer term contracts.
Okay, well, that concludes also our time. Thank you so much for your questions. Thank you so much for joining us once again. We'll be back in 2 weeks' time with another episode, another update. If you have any questions in the meantime, feel free to send them to our team, either through support@𝗕𝘂𝗁𝗲𝗂.com, or if you need an immediate answer, Seb@𝗕𝘂𝗁𝗲𝗂.com is usually the best outlet. And we'd love to see you back here in 2 weeks' time. Thank you.
Thanks a lot.
Bye-bye.